Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Before I dig into the company of focus this week, a quick note on Sasol. I specifically want to refer back to Supernatural Stocks on the 24th of May entitled Sasol 5 Miracles and a Dream. In that podcast, I laid out my views based on the Capital Markets Day event hosted by the company. The share price had already turned higher based on the management's story to the market, and it's been on a charge ever since, up more than 20% since that podcast came out. In that show, I set out the 5 miracles that needed to happen for Sasol to do well and to reach their long-term goals. I cannot stress this enough. If you think that a short-term rally in Sasol is a guarantee of longer-term success, then you really do need to start drawing longer-dated charts. Even after this rally, Sasol is trading at less than a quarter of where it peaked in 2022. Be careful and keep in mind that Sasol needs decent oil prices, improving margins in the chemicals business, better South African infrastructure, and the avoidance of both a global recession and a global stagflation environment in which debt stays expensive. Well done to those who have taken a punt here. I chose to sit on the sidelines for this one because I just find it too difficult to really know the right point at which to get off the Sasol bus. I also dislike playing guessing games when it comes to geopolitics, preferring to buy growth stories that are not reliant on exogenous factors. With that out of the way, we get to the company that I want to talk about this week, Virgin Active, which of course is part of Brait. First, we need to talk about where Brait has come from, because the long-term share price chart is incredible. There's probably no better way to see the story of the JSE since the global financial crisis, in which investment holding companies, and property funds for that matter, managed to attract huge allocations of capital from roughly 2014 to 2016, based on the promises of finding great deals, especially offshore, with institutional investors trying desperately to put as much distance as possible between their money and Zuma's government. Any management team that could show a history of travel to London was given an allocation. This had a predictably bad outcome. Brait peaked at over 165 Rand a share, which feels almost impossible when you look at the current share price of just over $2. As I said, it's a wild chart. Then again, if you look over the past 12 months, it's equally wild because Brait is up almost 130%. There was plenty of buying of shares by Christo Visa along the way, all of which gets announced to the market as a director dealing. It's very foolish to ignore director dealings, so be sure to include them in your investment toolbox. Another great example of that at the moment is Santova, which is enjoying a wonderful rally after the juicy combination of a fresh deal announcement and then some buying of shares by directors. But back to Brait. It's been a dog, but this dog is finally having its day. There is no chance on earth that it ever gets back to its old levels, but that's not the thesis right now. The market is instead looking at how much growth they can achieve from this point onwards, and this requires an assessment of the two major assets in the group. Premier is the value unlock poster child and is separately listed these days. Not only did this give the market better visibility of the company, but it also gave Brait the opportunity to offload part of its stake. The proceeds were then used to repurchase debt at a favorable price. There are some good decisions being made at Brait these days when it comes to capital allocation. Of course, it helps tremendously that Premier is performing so well at the moment. EBITDA growth of 15% year-on-year is rather delightful, with the company getting on the right side of the operating leverage equation in its business. Much like its sector peer Tiger Brands, it's about those last few hundred basis points of revenue growth and the impact that this has on the bottom line. Premier's share price has doubled in the past year, with Brait obviously riding this benefit as well. The market knows that Brait is enjoying a far better balance sheet position with such a large, liquid stake in Premier that can be reduced if required at favorable prices. Clearly, the listing of Premier has been a successful value unlock. Now, if Premier is a great example of how Brait has already unlocked value, then Virgin Active is the clear opportunity for the next value unlock. A listing of Virgin Active is on the cards at some point, and this is critical because Virgin Active contributed 61.6% of Brait's March 2025 net asset value. That's a whole lot bigger than Premier at 32.5%, along with the sad and sorry tale of New Look at just 2.9%. The gym group has at least stabilized after such a tough time during and after the pandemic. The value of the business measured in pounds only increased by 1% in the past year, with a slight dip in the level of maintainable EBITDA. They are still valuing the company on a forward EV/EBITDA multiple of 9x. Now, I've always seen this as being too high, but Brait continuously reminds the market that this is a discount to what the peer group is trading at. This debate will eventually be settled when the South African investor community gets the opportunity to own Virgin Active directly if it does ever list separately and price discovery takes place. The growth strategy at Virgin Active is certainly interesting. The Brait results presentation talks about the evolution of the business from fitness clubs to a wellness offering, thereby vastly increasing the total addressable market, or the TAM. Now, it's easy to put this stuff on a slide in a presentation. It's another thing altogether to deliver on the opportunity. My local gym looks exactly like it always has. If I even think back to my high school days of gymming at Old Ed's in Joburg, I can't say that much has changed since then either based on my current gym experience in Cape Town. That's 20 years of this product being pretty consistent, so Virgin Active will need to show us what they mean with their plan to increase the TAM. Something I do need to keep in mind though, and so should you, is that Virgin Active is much bigger than just a South African business. The state of your local gym isn't necessarily a good indication of what the gyms look like elsewhere in the world. Gyms are as far afield in the Virgin Active group as Italy and Asia Pacific. Having said that, South Africa is around 35% of the business, with Italy as the next largest region at 27%. This is followed by the UK at 24% and Asia Pacific at 14%. Interestingly, South Africa is achieving revenue growth of 16% year on year, so the arguably mature business is growing as quickly as Asia Pacific, the smallest business, and well ahead of Italy and the UK at 11% and 10% respectively. The sources of growth are far more interesting though, as South Africa only increased its membership base by 2%. The rest of the growth is thanks to pricing, with a focus on selling more higher value memberships. Now, I've heard that the refurbished clubs do tend to become more expensive for members, so there seems to be a clear drive here to get members to essentially pay for upgrades and drive return on investment accordingly. That's a sound business strategy, provided that the market can bear it. I simply have to highlight the performance of Kauai. Before you think that it's too small to matter, I would like to point out that Kauai generated more revenue for Virgin Active than their entire Australian business in the 4 months to April 2025. On the EBITDA line, Kauai's contribution to the group was 36% of the size of the UK business, despite revenue being only 27% of the size of that business. These are just arbitrary comparisons, obviously, with the point being to show you that Kauai and its excellent business really does matter. This is one of my favorite food options in the market, and it's a great case study in the value of differentiation. As someone put it to me so eloquently the other day, Kauai is a rare example of a takeout joint where you can't get a side of chips. So what does the future hold for Virgin Active? They are currently at a run rate EBITDA of £121 million, and the medium-term goal is to get to between £180 and £200 million. Now, the phrase medium-term can mean just about anything, but the point is that they are looking to grow. To support this growth, there's a significant capex plan for the next 3 years for not just maintenance, but also new clubs and what they refer to as premiumization. In other words, the focus on making the gyms better and thus worthy of higher membership rates. But where does this leave Brait? Brait's share price growth over the past year is very much thanks to Premier and the look-through value, rather than Virgin Active. Brait's net asset value per share based on March 2025 numbers is R2.80 on a diluted basis, with the share price currently trading at R2.18 at the time of recording. The discount to NAV is larger than those numbers would suggest though, as Premier's share price is up by almost 10% since the March 2025 balance sheet date. If Premier is what you really want, then you can just buy it directly. Although there's an argument that Brait is a discounted exposure to Premier, it's probably a bit too noisy for that justification in my view. You need to remember that Premier is only roughly a third of the Brait story. A long position in Brait would therefore need to be justified by your belief in Virgin Active. So it really comes down to this question. Do you believe that Virgin Active can successfully make the clubs more of a premium experience with a wellness offering attached? That's a stretch for me personally, pun shamelessly intended, but I will tell you what though, I'll do my best to help out with all of the smoothies that I seem to buy at Kauai. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.